Welcome to the Alternative Investing Doctor podcast. Here, we're helping physicians create financial freedom while maintaining professional fulfillment. The focus of today's podcast is to discuss two fundamental questions for physician investors. What's your true why for investing? And what investing style actually fits your personality and lifestyle? It is very typical to follow generic financial advice without considering if it fits your unique situation. In today's episode, I'll help you understand how to identify your investing why and determine what is your specific investor profile. Now, building wealth is very different than just having a high income. And actually, for a lot of physicians, it is difficult to build wealth despite our relatively high incomes. Traditional investing advice is often misaligned with physician careers. Physicians have a relatively late start to earn their significant incomes and often come out of training with substantial student debt or student loans. And then there is the downward pressure of reimbursement, which seemingly gets cut every single year. And there is rising administrative burden, which is driving physician burnout. According to the AMA's 2024 National Physician Comparison Report, physician burnout rates had fallen to 48.2%, down from a peak of 62.8% in 2021. But that still means nearly half of physicians report experiencing at least one symptom of burnout. I would suspect that this seems still a little bit low compared to the experience that I see with most colleagues that I've worked with throughout my career. But I'd be curious if that's been the experience that the rest of you have had as well. Now, many follow prescribed financial paths without really questioning whether this aligns with your own personal goals. I fell into this same trap, particularly early in my training, where I really had no financial literacy. I honestly didn't even know the difference between a Roth and a traditional 401k or IRA account. So I just went ahead and set up a 401k with the basic settings. And actually, initially, because I didn't know any better, mine was even invested in just bonds instead of any stocks or any index funds, right? So I think it's pretty common for people to get into that trap, just start putting money into a retirement account and have no idea what that is doing for them. And so I think it's really important to really understand what you're putting that money away for and why you're doing it. So that's really where the focus of today's episode is, right? So those two critical questions so that we can start to transform our financial trajectories. So as I mentioned, in my personal journey, I was following that conventional wisdom. I was putting money into my retirement account, although I wasn't always 100% sure what the allocation was or how I should do that properly. And I felt like that looked pretty good on paper, but turns out I was missing a lot of information. And by the time the COVID pandemic rolled around in 2020, that did give me a little bit more time off. And like many people, I developed a new hobby. And for me, thankfully, what I decided to do was learn about the financial markets. So I took a big interest in stocks and options and really started to explore those markets. Started doing a little bit of day trading and had a little bit of success here and there, but ultimately never really felt like the volatility of the market was the right fit for me. And I eventually became an accidental landlord when I moved across the country after residency. And rental properties produce some good cash flow, some good tax benefits, but really there's a lot of stress and headache that comes along with dealing with tenants. So all of this looked great on paper. I was making some progress, but I really felt like there had to be a better way. And some of the catalyst for that was rising interest rates. As we were seeing that significant inflation after the pandemic, I started to look for alternatives, right? So real estate was becoming less attractive. Prices had risen so high. And then with mortgage rates increasing, it was actually not making sense to try to cash flow a rental property anymore. And during that time, I happened to come across information about actually investing in the other side of the equation, investing in the debt. And that's what got me really interested in my current path, which is investing in mortgage notes. Now, that's kind of the strategy that I've settled on, but I think it's also important to consider, well, what is my why? So I had to really start to figure out what was important to me and what would be my goals. So a reasonable goal would be to build up as big of a retirement account as possible and then work full time until I reach that retirement age and then enjoy the fruits of that labor in the future. That really, for me, isn't the fit. So I'm very interested in making sure that I have flexibility and more time to spend on my hobbies, more time to spend traveling, more time to spend with friends and family. So I really actually want more income that is passive or doesn't require me to be seeing patients. I want that earlier in my career rather than later. So that is another reason that I've gravitated towards mortgage notes, because they can help me produce cash income without actually having to trade my time for it. So I think it's important to think about what might be your why, right? So for me, my real goal is, okay, I want to be able to reduce from a 1.0 FTE to maybe a 0.75 FTE in the future. Maybe I want to do that within the next year. And right now that would be, I think, a very reasonable goal for me. And for you, it might be something entirely different, but I think that's an important thing to start to think about, because then that can help you further determine, okay, what is the right investment strategy for me to take that might help me to achieve those goals? Because if you're perfectly content with your clinical career and see yourself working full-time throughout retirement age, then that's fantastic. Then you should probably focus more on strategies that are going to build wealth without necessarily giving you cash flow today. And if you're absolutely 100% burned out and want to quit medicine tomorrow, then you should be maybe more all in on income producing strategies with maybe a little bit of a mixture of wealth building strategies. So it really ultimately depends on what is your current situation, how happy are you with it, or do you need some type of a change? So then I think it's important to consider what might be your investor profile. And at the core, there are really 4 fundamental types of investors. There are those who want to be very active and those who want to be very passive. And then we can further split those into 2 categories. So on the active side, you have someone who might be an active controller. This would be someone who wants to hands-on manage the assets and have full control of all of the details and decisions, as opposed to an active delegator. This would be someone who wants to be involved in decisions, but wants to delegate a lot of the management, doesn't want to deal with all of the day-to-day of every single little nitty-gritty detail. Then on the passive side, you would have someone who'd be more of a passive participator. They want limited involvement with occasional input, but don't want to be completely left in the dark. And then lastly, you would have someone who'd be more of a passive allocator. They put their money somewhere into an investment. They don't really want to hear about it or don't need to think about it and want to be more completely hands-off. So I find myself to be more of an active delegator. I like to use my analytical skills to analyze deals, make sure it's a good fit, make sure I'm minimizing my risks. But then when it comes to day-to-day operation or day-to-day management, I really don't want to do that. So in mortgage notes, I am content to delegate that to my servicer, who can handle dealing with collecting payments, any communications with borrowers. All of that is off my plate, and that's just how I like it. So with this in mind, this is how I was able to start to shape my investment strategy and also guided my exploration of different investment strategies. Stock market and options are definitely a mixture of active and passive depending on how you're doing them. But in most cases, for example, if you're just investing in the 401k in an index fund, that's on the very passive end. And I really don't like that lack of control, right? So that's not fitting my investor profile. Rental properties definitely are more active, but actually a lot of the time they are too active. So that is another situation where wasn't quite the right fit for my investor profile. So that's where mortgage notes kind of slide in and really kind of tick all the boxes for my specific profile. So then if you want to find your true why, there's a few specific questions you should ask yourself. The first would be, what specific change now would make the biggest positive impact? The second would be, what is your actual timeline? Are you looking to retire in the next 1 to 2 years? Or do you want to achieve a certain income level within 1 to 2 years? Or is your time horizon 15 or more years down the road? And then you really have to think about how involved do you really want to be? Do you want to be hands-on, or do you prefer to be completely hands-off? And that's really going to help you start to drill in on your profile. Other things to consider would be your time availability. How many hours do you realistically have that you can allocate to investment activities? If you want to spend a lot of time with your family, or you are completely swamped with your clinical work, then choosing a very active strategy might not be the best option. You also need to think about what is your control preference. If you want to be in control of all of the details, then probably just investing in index funds wouldn't be the right fit. Next, you should consider, do you have an analytical inclination? Do you enjoy doing research? Do you enjoy analyzing deals? Then in those cases, you might want to look more into strategies that do require due diligence, as opposed to just writing a check to someone and letting them manage the money for you. And then lastly, how about crisis response? So how do you typically handle unexpected challenges? If those stress you out and make you feel like you want to give up and go do something else, then things like maybe rental real estate, multifamily investing, where emergencies and calls come up at unexpected hours might not be the best fit. So then again, to take those examples another step further here, you can then match your investment strategy to your specific profile. So if you really want to be that active controller, direct real estate, actively running a business, or really actively managing notes, that would mean actually finding the note, maybe creating the note, and maybe servicing it yourself. Those would be active strategies. If maybe you're more like me and are a bit of an active delegator, buying things like performing notes is fantastic. Doing private lending, maybe turnkey real estate as well would be good options for that category. If you're more of a passive participator, things like real estate syndications, private funds, and fractional type investments might also be good options. And then finally, for those passive allocators out there, things like index funds, REITs, and managed accounts might all be good options. So to summarize, I think it's critical to find your why for investing. You need to know why you're doing this and really what is your specific goal that you're trying to achieve. Once you know what that why is, I think you can take that next step and determine what type of natural investor profile suits you. And then once those 2 points are very clear, that's going to allow you to know which strategy you can choose that's going to align with both. And it doesn't just have to be one. As we mentioned, there are at least several different types of investments that fit each investor profile. And there are a whole bunch of other investment strategies that I certainly did not include in those lists. They were by no means exhaustive. So in the near future, I'm looking to produce a physician investor profile assessment that might help you better identify what type of investor you are. So go ahead and subscribe to the podcast to be notified when it launches. So to wrap up here, I think that your investment strategy should be as personalized as the treatment plans you produce for your patients. Thanks for listening today, and we'll see you in the next episode.